For me, my big focus is on linking the geopolitical pressure points with equity, bond markets, and global economic activity. I think that equity markets either have climbed a wall of worry or still climbing it. There's so much euphoria that one needs to think very carefully is that euphoria justified? And I think that the markets seem to be assuming that Trump is going to produce peace between NATO and Russia over Ukraine and peace in the Middle East. Both, I think, are very doubtful indeed. I think on Ukraine, Putin had hoped that he would be able to work towards a managed peace with Trump over Ukraine, but has concluded that that is no longer possible. I think we're going to see an acceleration that over the summer months, Russia will gain whatever territory of Ukraine that they need for their future security. That will include Odessa and Kiev. That will happen with or without the intrusion of certain EU countries into Ukraine. It makes no difference. What has actually happened is Russia demolished a Ukrainian military station with a new missile called the Orshnik. This is a major game changer, and it effectively means that Russia does not need to threaten the world with nuclear warheads. The other interesting development is that the location of these new missiles will be in Belarus. Therefore, the whole of Europe will be in the range of the Orshnik missile. There are two reasons why Washington is extremely worried about China. The first, as we know, is China's super efficient and competitive manufacturing supply chain, which is being further enhanced by their adoption of automation and robotics fueled by AI technology. So now they have factories physically running with humanoids with no human beings on them. And the second point is that Washington now perceives that in many high quality and important military equipment, China is now surpassing what America has. So this leads you to the obvious conclusion that we've known for a long time, that America's ultimate objective is to strangle China. China knows it, just as Russia knows it and Iran knows it. This is the real war that is evolving, and it all links into Washington's objective of destroying BRICS before that organization matures into being a real risk to America's dollar global domination and its hegemony. This is what the tariffs are about. It's what these regional wars are about, and it's what America's use of the dollar is all about. So what it's really about is the world going to be a unilateral one or a multilateral one, the former being led by America and the latter by Russia and China. This comes back to the close links between Russia, China, and Iran. Washington perceives Iran as being the weak link. Therefore, if you break Iran, then you're going to weaken Russia and China. So the war between Israel and Iran is not just between the two. Israel has always been and will continue to be 100% supported by America, the UK, and France, Israel's founding fathers. So we're only just the beginnings of this Middle Eastern war, and we can expect in weeks, if not days, another joint Israel-America attack on Iran. Of course, when and if that does happen, that is going to be a risk that equity markets are not yet perceiving. Well, I think the first thing is we need to look under the hood, what's going on in the American economy. And the economy is probably on the point of recession. Incoming data is weakening. Look under the hood of the employment data, and it's not nearly as robust as being pointed out, particularly with what goes on with the birth-death model. Look at CPI being reported around 3%, whereas Larry Summers took the methodology back to 1983, and his team concluded that last year CPI was 9%. which neatly fits into what John Williams of Shadow Government Stats, who goes back to pre-Arthur Burns days in the 1970s, and came out with an inflation figure of 10.8%. And you can say that households know the real rate of inflation much better than the 300-odd economists in the Fed. If you look at retail sales and consumer spending in the first quarter, in nominal terms, it only rose by 1.2%. What you also had in the first quarter was a massive surge in imports as companies brought stuff into America before tariffs became operable. So that will have to unwind itself in the second and third quarters, probably at a point when the consumer spending is going to be much weaker. So I think there's real risk that the US economy by the end of this year will be in recession. Then there is a very interesting report produced by the Boston Fed. Bank lending to the 1.6 trillion private credit industry may pose systemic risk to the US financial system during an economic downturn. They quote, banks' extensive links to the private credit market could be a concern because those links indirectly expose banks to the traditionally higher risks associated with private credit loans. So there's another time bomb ticking. And if we're right that the American economy will soon be in recession, then this sleeping time bomb could well explode. What I'm trying to say is that if you link what's going on geopolitically with a weakening economic and financial structure, not only in America, but in Europe too, then there are a lot of hurdles to be surmounted before you can get the economic recovery getting underway. Even then, my fear is that in order to save the system once again, the Fed and other G7 central banks are going to flood the system with liquidity, which will lead to another inflation surge reminiscent of what happened in the 1970s and 1980 and 1981, so that we don't have real recovery. We're going to have stagflation with inflation rising faster than economic activity. That's my big fear. I think that is a very strong bet that we're going to see a resurgence of not only US but global inflation, such that we saw in 1979 and 1980, when I think CPI in America was 13%, and Paul Volcker had to push Fed funds rate up to 15%. I think at one point it was as high as 20%. What does that do to a highly indebted US and global system? So I suspect that over the next month or so, we will see 10-year treasuries coming down to 3%, and we will see a massive bear market rally in the US dollar, orchestrated probably by the Treasury, because it will be the basis for the Treasury's ability to refinance that $7 trillion, not at 4 or 4.5%, but at 3%. That's a huge savings. Gold could dip a little bit further, but frankly, that's only very short term. Gold is definitely going probably over the next 2 years to $5,000 on the back of resurgence of inflation, but more particularly because of geopolitical tensions. Copper prices should not be around the 10,000 level. They should be closer to 7,000 because demand is no better than just okay. And at these prices, fabricators are just sitting on their bums, using up their long-term contracts and any surpluses that they've got on hand, because at $10,000 does not make sense. The reason why copper is at these levels is that the big boys are playing the game of assuming that Trump will introduce a 10, 15, 20, 25% tariff on the importation of copper. So we're probably seeing between 400,000 and 500,000 tons of physical copper that should have been lying in warehouses and being shipped to Europe, Asia, China, etc., actually going into America. So you're seeing this huge buildup of inventories in America on the expectation that Trump will introduce an importation tariff on copper cathode. There will be a huge tax on the exportation of copper in scrap, which in contained copper terms last year came to something like 700,000 tons of copper, of which 400,000 went into China. So we know that Trump eyes China as a competitor. So if he can stop an important lump of copper going into China, then that's going to cause China some problems in his view. I think the conclusion is very simple. Despite what markets and their analysts are saying, we are entering a very volatile and dangerous 5 to 10 years. So security must be the dominant policy for households. We'll enter a period in about a year's time when food prices will be soaring. There'll be a lot of shortages of key stuff like meat, grains, fruit, etc. So stock up whilst you can before prices take off. Inflation is coming, so prepare for it.